For centuries, United Kingdom shaped global finance, trade, and innovation. London was the city everyone looked to. But today, the picture looks very different. The UK, once a historic powerhouse that led global markets, is now at risk of slowly becoming just history. Unemployment is up to 4.7%, the highest in almost 4 years. Youth unemployment has hit 14.2%. That's 1 in every 7 young people unable to find a job. And the broader economy isn't doing much better. Retail sales have been falling for 10 straight months, as much as 34% lower year-on-year in July 2025, according to CBI survey data. In 2024, around 13,479 shops closed. That's about 37 shutting down every single day. The financial market isn't giving us good news either. In the first half of 2025, London saw just 5 IPOs, raising just £160 million, the lowest in 30 years. In the full-year outlook? Just 9 IPOs, the lowest since 1997. Yes, according to global rankings, London is still the second biggest financial center in the world, right after New York. But if you look at IPO activity, retail sales, or employment, it's clear. London just isn't as attractive as it used to be. So why is capital leaving? Why are places like Dubai and Singapore rising so fast, drawing business away from London? Why are even British brands preferring to list in the US? London is becoming a tougher and tougher sell. Let's break down how this century-old financial center ended up here. Short-term pressure, high interest rates. The Bank of England has kept rates above 5% for a long time to fight inflation. But that's pushed up borrowing costs, cut investment, slowed housing and infrastructure projects, and caused big layoffs in construction, retail, and hospitality. The bigger issue, though, is long-term structural problems. Things like rigid systems, heavy regulation, slow approvals, high labor costs, and wasted resources. For example, roadworks are often redone repeatedly, wasting time and money. The economy still relies heavily on old pillars like finance, the NHS, and education, while new industries and innovation just aren't growing fast enough to create jobs. Lagging in infrastructure and technology. London is falling behind Asia and the US in data center capacity, 5G coverage, and fintech sandbox development. Startups see Singapore or Dubai as far more business-friendly, with faster approvals, government support, and smoother entry. Policy inconsistency. Frequent prime minister changes mean unstable tax and financial policies, which makes long-term planning tough. Meanwhile, Singapore and Dubai offer stable, predictable policies, much more appealing to investors. Financial services are still the UK's biggest export. London is still a hub for lawyers, accountants, arbitration, and asset management. But underneath the surface, things are slowing down. Wage growth in financial and business services is only 3.1%. Back-office jobs are shrinking, hiring is slowing, and most deal flow is just existing business, not new growth. More and more companies are skipping London to list in the US, Singapore, or Hong Kong. Not because investors aren't there, but because London's process is slow, complex, and conservative. Even when regulators give feedback, it's vague. Companies often have to interpret, rewrite, or even resubmit. The numbers tell a worrying story. First half of 2025. Only 5 IPOs. Forecast for the year. Just 9 IPOs. In 2024, 88 companies delisted. In 2025, another 70 are expected. Compare that with the US and Asia. According to EY, 74% of global cross-border IPOs came from Asia-Pacific, and 93% of those chose the US market. Even with reforms, London hasn't regained its edge. The fact that ARM, a flagship British tech brand, chose to list in the US is hugely symbolic. When IPOs leave, London doesn't just lose the fundraising, it also loses the legal, accounting, and underwriting business that comes with it. Even without high rates, borrowing in the UK is harder. Banks are conservative, lending only to firms with long track records and stable cash flow, usually demanding full collateral. SMEs can't just walk into one bank and secure funding. And even if rates come down, business loans still carry heavy legal, compliance, and admin fees, plus rigid terms. Meanwhile, the US has a deep bond market and a strong VC ecosystem. Singapore and Dubai have low taxes, government funds, and loan guarantees that make financing much easier. The UK raised corporate tax from 19% to 25%. Dubai's is just 9%. Singapore's around 17%, with plenty of exemptions. Also national insurance, high capital gains tax, and stamp duty, and the cost of hiring and trading goes way up. On the personal side, top income tax is 45%, pushing talent away. The deeper issue. The government seems more focused on how to collect more tax than on attracting capital or boosting competitiveness. Dubai and Singapore do the opposite, they grow the pie first, then collect tax from the bigger economy. In the UK, it feels more like slicing up the same pie into smaller and smaller pieces. Dubai has low or even zero taxes, backed by sovereign wealth funds and oil dollars. Trading volumes are booming, and it's open to fintech and digital assets. Singapore offers low taxes, stable policies, and efficiency, with reach across Southeast Asia and into Australia. Global capital is flocking there. There is two types of outflow. Passive, clients move their business abroad, and the whole service chain, lawyers, accountants, IT, fund managers, follows. Active, financial firms themselves move. If they see no growth in London but better opportunities in emerging markets, they'll open branches or even shift headquarters. That's exactly what Standard Chartered and HSBC have been doing, expanding in Singapore and the Middle East. London still retains certain roles that aren't easily replaced. But once emerging markets can offer the same services more efficiently, companies will ask, why not just do everything there? And when that happens, it won't be a slow decline, it'll be a sharp cut. London could lose entire business chains at once, with no easy way to win them back. Wrapping up, in the short term, London is still supported by existing clients and historical momentum. Then medium term, growth may flatline, but the long term, its core functions risk being eaten away by Dubai and Singapore. Unless the UK moves faster to reform, cutting costs, improving financing, fixing its tax system, its financial edge will continue to fade. So let me throw this to you. If you were running a financial firm, would you bet on London's legacy and stability? Or would you look to emerging markets with lower taxes, easier financing, and faster growth? Which one would you pick? Drop your thoughts in the comments.